But I'm here to tell you the terrifying truth. The politicians and central bankers keep hidden in the shadows of power. That moment of financial freedom. It's not salvation. It's the trigger for a global catastrophe. The day America pays its debt is the day the entire world economy commits suicide. And the secret reason why is far darker than you can possibly imagine. The story begins not with recklessness, but with necessity. Forged in the fires of global conflict, the U.S. debt instrument, the Treasury bond, was originally a simple promise to repay the people who helped fund the war effort. But after 1944, at Bretton Woods, the debt took on a new, insidious role. It became the keystone of a rebuilt global financial system. When the gold standard tether finally snapped in 1971, the world needed a new anchor. And that anchor wasn't oil, or wheat, or even the dollar itself. It was the safest asset in the world, the U.S. Treasury bond. Consider the scale. Nations like China and Japan, massive sovereign wealth funds, pension funds, managing the retirement of millions, and commercial banks globally set, all hold mountains of this debt. Why? Because the U.S. Treasury market is the bedrock of liquidity. It is the asset they can sell instantly, anywhere, anytime, without destroying its value. It's the collateral for countless trillions in loans, derivative contracts, and financial insurance. It is the very definition of a risk-free rate of return, upon which every single financial calculation, from a 30-year mortgage to the pricing of a complex credit default swap, is based. This wasn't just a government IOU. It was now the circulatory system of global capitalism. We didn't just borrow money. We sold the world the foundational component for its entire modern financial architecture. The problem metastasized in 3 distinct phases. First, the age of entitlement, 1980s, 2000s, where politicians across the aisle discovered a chilling, addictive truth. You could buy votes today with money you didn't have, simply by issuing more debt. The market swallowed it greedily, believing the U.S. promise was infinite. Then came the great financial crisis of 2008. This was the moment the debt transitioned from a simple asset to an existential necessity. When the world was drowning in toxic mortgage-backed securities, where did all the smart money run? Straight into the arms of the U.S. Treasury, desperate for safety. This flight to quality proved one thing. The system needs U.S. debt more when things are bad. It is a financial fire extinguisher. Finally, the era of monetary madness, 2009 present. The Federal Reserve, realizing the power it wielded, became the buyer of last resort. Through quantitative easing, the Fed literally conjured money from thin air to buy up Treasury bonds, simultaneously suppressing interest rates and funding the government. This created a perverse economic feedback loop. High debt levels forced the Fed to keep rates low, and low rates encouraged the government to issue more debt. It wasn't a sustainable cycle. It was a debt treadmill that was accelerating dangerously. Now we arrive at the chilling core of the conspiracy, the part no one dares to articulate in the light of day. The system is not designed for debt repayment. It is designed for debt maintenance. The fundamental, hidden truth is this. U.S. Treasury debt is the world's most critical financial input, is the raw material. Imagine the global economy as a complex machine. The gears and pistons are international trade, commercial loans, and daily transactions. But the oil that keeps every piece moving, preventing the entire thing from seizing up, is the supply of safe, fungible U.S. government debt. If the U.S. were to suddenly pay off its entire outstanding debt, say, by massive taxation, asset liquidation, or some financial miracle, we wouldn't be financially free. We would have instantly obliterated the world's supply of high-quality collateral. Banks would panic. Their regulatory requirements demand they hold a certain amount of safe asset. If that asset disappears, they cannot meet their reserve requirements. Trillions of dollars in over-the-counter derivative contracts would become impossible to price or hedge, because the risk-free benchmark rate is gone. The repurchase agreement, repo market, the shadow market that banks use to borrow cash overnight using treasuries as collateral, would instantly lock up. The twist. The U.S. Treasury market is not just a government funding mechanism. It is the global reserve asset. To eliminate it is to eliminate the benchmark for money, the basis of trust, and the financial foundation for nearly every major institution on Earth. It would be an act of financial disarmament, instantly triggering a liquidity crisis that would make 2008 look like a minor market correction. We are literally held hostage by our own IOU. The fallout would be swift and brutal. First, a global liquidity blackout. With the collateral gone, interbank lending freezes. Banks stop trusting each other. Commercial paper dries up. The lifeblood of corporations' short-term funding. Businesses that rely on cash flow, not profit, to survive instantly become insolvent. Mass corporate bankruptcies sweep the globe. Second, the retirement annihilation. Pension funds, which rely on the steady, safe return of Treasury bonds, would find their portfolios suddenly devoid of their safest asset class. They would be forced to pile into riskier corporate bonds or equities, driving up prices just before the inevitable crash. Or worse, they'd simply have nothing to hold, leading to a massive funding crisis for retirees. Third, a dollar paradox. While the US would be debt-free, the dollar status as the global reserve currency would be undermined. If the world cannot hold US debt, they have no reason to hold US dollars. The price of the dollar would become violently unstable, leading to an unprecedented period of global trade chaos, as every major commodity, oil, gold, grain, is thrown into pricing anarchy. Who benefits? The few hyperliquid financial institutions who saw it coming and had already moved into hard assets and non-systemic stores of value. Who loses? Everyone else. The worker, the retiree, the small business owner, all caught in a financial maelstrom triggered by a political impossibility. To understand the danger of today, we must look not just to the past, but to its echoes. The great financial crises are always about a loss of faith in the underlying asset. Consider the euro-dollar system, the vast, multi-trillion-dollar market for US dollars, held outside of US borders. It's the engine of global trade, and it relies entirely on the steady supply of US debt. Today, the sheer volume of that debt, and the political brinkmanship surrounding the debt ceiling, has created a chilling parallel. In 2011, 2013, and recent years, political gridlock threatened to halt the government's ability to issue new debt. This wasn't a threat to repay old debt, but a threat to maintain the necessary supply. Each time, markets flinched, and we witnessed the flash of the coming darkness. Short-term Treasury rates spiking, the cost of credit rising. The shocking similarity is this. The political fight today isn't about fiscal responsibility. It's about playing Russian roulette with the foundation of global finance. The politicians are treating the sacred anchor of the world economy, the Treasury market, as a political bargaining chip. They are, in effect, threatening to stop the machine, not by paying off the debt, but by simply failing to issue the new debt required to keep the system running. The audience must care now because the stability they feel is an illusion. It rests entirely on the assumption that the US government will continue to borrow forever. Your mortgage rate, your 401k, the price of your food, it all flows back to the simple, terrifying fact that the world needs America to be indebted. The next 6 to 12 months will be defined by the collision of two forces: relentless inflation and structural dependence on debt. As inflation drives up the nominal size of the government's spending, the Treasury must issue even more debt to fund the difference. This massive supply glut is forcing the Fed into a difficult choice. Scenario: the Fed is compelled to keep interest rates relatively high to fight inflation. But high interest rates dramatically increase the cost of servicing the debt itself. The interest payments alone could soon rival the defense budget. The most probable scenario is the Minsky Momenta tipping point, where the perceived safety of the asset finally breaks under the weight of its own mass. Foreign buyers will quietly begin to accelerate their divestment, having lost confidence in the US political system's ability to manage its finances. This won't be a sudden default. It will be a slow, agonizing loss of primary reserve status. The world will not find a single replacement, but will begin to fracture into currency blocks: the yuan, the euro, possibly a basket of commodities. The US will remain powerful, but its financial hegemony will be fundamentally and irreversibly degraded. This process starts subtly, with a small reduction in Treasury purchases, but its momentum will be a future force of nature. The ultimate paradox of the world as superpower is this. America's financial strength is predicated on its weakness. Its stability is built on the sheer, impossible volume of its debt. We are not sailing toward a glorious payoff. We are locked in a golden cage, where the key to our freedom is zeroing out of our debts. Also the key to our total systemic collapse. The debt is not a chain of bondage. It is the lifeline of the modern financial order. The final warning is simple. When you hear a politician promise to pay off the national debt, understand that they are not offering you salvation. They are unwittingly proposing the end of the world as we know it. Because in this dark new world, solvency is the most dangerous path of all.